Welcome back. You've got the market, which is up 45 points now, 24,750. Gautam Duggad is with us, Head of Research, Institutional Equities at Motilal Oswal Financial Services, as the Motilal 20th Annual India Conference comes to a close later today. I think, Gautam, great to have you back on the program. Thank you for your time. You know, when we spoke with Ramdevji on Monday when the conference was kicking off, he said, well, he'd be watching on for two things, two main things. One is when will foreigners return, and if they will return or they'll be deterred by valuation still. And second is what is happening on the ground, because post-COVID recovery has been not even. It's been very varied across sectors. Why don't you answer your impressions on, with regards to both those questions?
Hi, Prashant. Good afternoon. Thanks for having me. So we'll focus more on what's happening on the ground, because whether FIIs return or not, right now it doesn't seem to have a much bearing on the market. So as far as what's happening on the ground is concerned, I think two important things that I could gather from the CEO tracks as well as some of the company meetings I've had the chance to attend. Rural seems to be turning around now. There are confirmations from many sectors where they are seeing good green shoots pick up in rural consumption after the last 2 or 3 years. So there is some impact of a good monsoon which is coming in, and also low base which is helping. Plus some of the companies will also benefit from the pricing impact that will come through from September, December quarter. Festive season expectations are building up in sectors like auto, consumer discretionary, consumer staples. So that is one element. Second, there is expectation that private capex will now start picking up. There are some signs of that happening already, gradually though, and the expectations are that they will build up further. That's what multiple corporates representing industrial segment have been talking about, whether it is green energy, renewables, or some of the traditional capex-oriented spending. As far as the first question is concerned on foreigners, yes, they are finding valuations very expensive in India. Relatively, yes, large caps are still reasonably priced at about 20-21 times Nifty, but mid caps and other broader segments of the market are very expensive, and that is what is deterring them, and which is also in a way reflected in the flows. This year's YTD flows from FI side now are down to just about $2.7, $2.8 billion versus a month back that number was about 8.5. And domestics on the other hand is chugging along very well. YTD domestic flows are almost nearing $35 billion. So that's why I said it doesn't matter as to when FI flows turn positive, because right now market is not too bothered about that particular segment of the capital.
Gautam, hi, good afternoon. Good to hear that. Good to hear that. But then how to marry this with your analysis at the end of first quarter, right? Because the fuel of every bull market, apart from money, the other important thing is obviously earnings. And then as one looks deeper into your strategy note after the first quarter, I'm looking at a couple of parameters. You know, the beat to miss ratio, which you say has turned a little more unfavorable, 43 companies missing estimates, 29% reporting a beat. And even the upgrade to downgrade number, that's very, very interesting, because 46 companies' earnings have been upgraded and 107 companies have been downgraded. So just take us through this, because you do acknowledge that earnings momentum is slowing down. Then what about the constant fuel for this bull market, the unending appetite for stocks that we have here with the domestic liquidity?
So Surabhi, if you recall, FY24, the first quarter was very strong. The last year we started at the peak as far as earnings growth was concerned, and then progressively we kept on moderating. And fourth quarter FY24 was the weakest in terms of the growth within that full year, if you compare the 4 quarters. FY25, it is completely reversed. We are starting right at the bottom as far as earnings are concerned for the year, and then progressively we are expecting the earnings to pick up. Overall, we still expect about 11% earnings growth for our coverage and 12% for Nifty for FY25. Last year, FY24, our coverage earnings were up 30% and Nifty earnings were up somewhere close to 25%. So base is quite strong, not just of last year, but last 4 years compounding also. If you see, Nifty profits have more than doubled from 3.5 lakh crore in FY20 to close to 8 lakh crores in FY24. So that's about 23-24% compounding. Yes, on that heavy base, this year's number looks slightly moderate, and it doesn't help that the year is begun on a very somber note as far as first quarter is concerned. But also remember that first quarter also had a heavy drag from OMCs. I mean, if I look at my 269 companies, the growth was just 1%. But the moment I remove those 3 companies and look at the other 266 companies ex OMC, the growth is about 12%. Right? Similarly, for mid-caps, our coverage universe of close to 85 mid-cap stocks reported a 5% earnings decline, which was in line. But again, in mid-caps also, if I look at numbers excluding oil and gas, the growth was close to 25% for mid-cap earnings for 1Q FY25, which was better than expectations. So
Gautam,
you have to look at numbers in totality, not...
No, I'm so sorry to come in there. I'm doing exactly that. I'm only sticking to the one big number that you gave us, which is 10 to 11% earnings growth for the full year, right? Assuming, like you're saying, that the second half is going to be better.
Yeah.
But if I look at 10 to 11% earnings growth full year for a market trading at almost 20 times, bordering 21 times, then what are we really talking about? That valuation question, which Ramdevji sort of raised, it becomes a huge burning question, does it not?
So, Surabhi, 1 year's growth doesn't decide P multiple of the market. Last year, we had a 30% earnings growth. Market didn't trade at 30 times for Nifty earnings, right? So, 10-year average is 20 times for Nifty. Right now, we are trading close to 20.5 times. If this year's earnings growth is about 11-12 and FY26 our expectation is about 18%, then we are talking about a compounding of 14-15%. So I agree that valuations are not leaving too much room for safety, even for large caps. So it is important that market spends some time in this range, consolidates, time corrects. The problem, Surabhi, is in the mid and small cap part of the market, where valuations are just too expensive. So mid-cap index, as per our numbers, is trading at 35-36 times 1 year forward. So that is a big premium of almost 75-80% premium to Nifty, which is unsustainable in my view. So that is an index where there is a problem. Small cap index trades at 27-28 times. That is again an index where there is a problem, because usually it trades at 20-25% discount to Nifty. Right now it is trading at a premium. So those are bigger concerns rather than just Nifty. And 1 year's earning will not change multiples much. What if the next quarter earnings are of 15%? Right? If the full year average is 11 and first quarter's number is 4%, that basically means that the rest of the 3 quarters markets are expecting the earnings to pick up. You can build the narrative either ways, that earnings are finally picking up after the worst quarter of the year is behind. Or you can say that for the current valuation, one particular quarter numbers are very bad. So these valuations are not sustainable. So that is something which the investor has to grapple with.
Absolutely. Take your point, and you answered that, because next year you're expecting the growth to pick up to 18% FY26. So at an average, I guess the point is that we're still looking okay. Reema.
Gautam, hi. So just want to drill down to individual sectors. So very recently, you all had upgraded IT to an overweight, citing an expected recovery. Now, there is a question mark on the strength of the US economy. Whether or not it goes into a recession, there are telltale signs of a slowdown. So based on your conversations with technology companies in the conference, is there any risk to the expected recovery in IT stocks, in the growth rates for this year or next year? Because the IT index has given a 25% return in the last 2.5 months.
Yeah, Reema. So IT stocks have done really well. We've had an underweight for a long time. We upgraded it to overweight in July. Not on the basis of any big pickup in earnings. The thesis behind our upgrade and moving it to overweight in our model portfolio is twofold. The sector has underperformed for too long. So relatively the valuations vis-a-vis other sector in the index were looking relatively better. Second, we were trying to move element of defensive component in the model portfolio slightly higher, given the concerns on the broader market valuations. So those are the two reasons why we moved IT from underweight to overweight. As far as the commentary of IT companies are concerned, I think we've all, again, just recently seen in earnings season also, there's not much change as far as commentary at our conference is concerned for IT sector. Everybody's in a wait and a watch mode. People have a lot of debates that are going on the quantum and timing of the US Fed cuts, as to how that eventually pan out for the US corporate spending on technology and digitization. So there are a lot of moving parts over there. Easy money has already been made in IT. So like you rightly mentioned, in the last couple of months, IT sector, especially the large cap, which were languishing for a very long period of time, they started moving up and now they are taking a breather. I think the next catalyst again would be as we move closer to the 2H FY25, how does the guidances of various large IT companies change? I think that will now decide the next move in the IT stock. I expect them to remain in a very tight range now because the market has rewarded them ahead of the recovery.
Got it. Gautam, thank you for joining us. Before I let you go, let me ask you this, slightly offbeat, but 3 days now you've been there meeting so many people. Tell us something that really sort of, made you go, wow, I didn't know that. You don't have to name who you heard it from, but was there a wow moment? Were there many?
There were many wow moments, especially in our CEO tracks. There were 15 back-to-back CEOs, representing almost all segments of the economy. For me, particularly, the most unique and wow moment was the Zepto CEO track, because the kind of insights our investors gathered from that CEO track was pretty rich. And the sheer fact that they're growing at a pace in quick commerce, within 2 to 3 years, they've reached a size which is unheard of. So there were a lot of granular insights which he shared, which definitely was the highlight of the conference for me.
And we will read about it in a report from you, Gautam, which would be as insightful. Thank you very much for joining us. Great conversation as always, and a wonderful conference there at Motilal. We'll take a quick, I don't think we'll take a break. We'll focus on Nykaa.